Hello everyone, my name is Eddie Landeros. I'm a senior business advisor and certified credit counselor with CDC Small Business Finance. Today we're going to talk about the 5 C's of credit, the things that every business lender looks at before approving you for a loan. The 5 C's of credit are character, capacity, collateral, capital, and conditions. Character is one of the most important C's when it comes to lenders, because character tells them whether or not there's a high probability of you paying them back. Character looks heavily on your credit report, looks heavily on your credit score. So it is important because they do analyze your credit report and they do analyze your trends, your payment history, whether or not you've paid banks in the past. And that's important to any lender. The second C is also very important, and it's capacity. And capacity tells a lender whether or not you can pay them back. One of the things that lenders do is they analyze your income and they compare it against your expenses. When they look at your income, they not only look at the business income, but also at your personal income. And again, they want to make sure that you have enough money at the end of the year or at the end of the month to pay them back. Capital is the third C of the 5 C's of credit. And it's basically the capital that you invest in your own company. Lenders want to see that you have some skin in the game. They want to see that you have some sort of down payment towards the project that you want to do. So if you want to expand and maybe buy another warehouse, or expand and buy more trucks, or expand and hire more employees, they want you to have at least 30%, give or take, of that project before they can give you the loan. Banks usually require about 30%. CDC Small Business Finance tend to be more flexible, and sometimes they go as low as 10%. Collateral is the other C of the 5 C's of credit, and it's important because that's how banks secure their loan. Usually traditional banks require you to pledge your home or pledge another real estate property that you may have, like an investment property. It's important for them because in case you are not able to pay them back, they can always foreclose on that property and get their money back. Alternative lenders like CDC Small Business Finance tend to be a little bit more flexible, and they do accept real estate as collateral, but they also accept vehicles. They're able to be a little bit more flexible and think outside the box. Collateral is important because that's how lenders get their money back in case you are not able to pay them back. The last C is condition, and it's also important because banks analyze the trends and the market conditions of your business. And if we're in a recession and there's not a lot of work for construction companies, there's some banks that will not lend to construction companies. That is a policy that banks tend to have whenever there's problems in a certain industry. Alternative lenders like CDC Small Business Finance tend to be a little bit more flexible with that, and they lend to any industry regardless of whether or not they're having a tough time in the market. So in summary, the 5 C's of credit are character, capacity, capital, collateral, and conditions. Thanks for watching, and make sure to check our video on how to fix your credit.